Ladies and gentlemen, buckle up, because tonight we're diving into a trade showdown that's got North America on edge, where one country's bold move is shaking up farms, factories, and even your dinner table. Picture this: American farmers staring down skyrocketing costs, White House insiders scrambling, and a critical mineral at the heart of it all. It's the kind of high-stakes drama that could rewrite alliances and hit wallets hard, and it all starts with Canada firing back. Potash producers hike export prices sharply to offset looming U.S. tariffs. White House sources say officials were completely unprepared. In the opening days of 2026, as trade tensions between Canada and the United States reach a boiling point, major Canadian potash producers have implemented significant price increases on exports destined for the U.S. market. This decisive action serves as a direct counter to President Donald Trump's repeated threats and partial implementations of very severe tariffs on Canadian fertilizer imports, particularly potash, a cornerstone nutrient for American agriculture. The hikes, reported across industry channels and confirmed through producer signals in early January, come amid a backdrop where the U.S. depends on Canada for roughly 85–90% of its potash supply. Saskatchewan, home to the world's largest reserves exceeding 1.1 billion tons, dominates global production, with companies like Nutrien and Mosaic controlling the majority of output from 11 active mines. These producers, facing potential duties that could range from 10%, as previously adjusted in 2025, to much higher levels under renewed threats, have chosen not to absorb the costs. Instead, they are passing them forward through elevated pricing on U.S.-bound shipments, effectively shifting the economic burden southward. This pricing strategy is rooted in the stark reality of supply dominance. The United States produces only a fraction of its needed potash. Estimates place domestic output at around 400,000 to 500,000 tons annually, against demand exceeding 5 million tons. Alternative sources like Russia and Belarus face sanctions, logistical hurdles, and higher transportation costs, making them unreliable substitutes. Even with minor operations in New Mexico and Utah, the U.S. remains structurally import-dependent, a vulnerability exposed repeatedly during 2025's tariff escalations when prices surged and farmers lobbied for exemptions. White House officials, according to multiple insider accounts, were caught flat-footed by the speed and scale of the Canadian response. The administration had positioned tariffs as a tool to bolster domestic production and reduce foreign reliance, echoing earlier moves that included broad 25% duties on various Canadian goods, later lowered for potash and energy. Yet the countermeasure highlights a miscalculation. Rather than spurring rapid U.S. expansion, which analysts note could take a decade or more and billions in investment, the policy has prompted Canadian firms to protect margins aggressively. Sources describe internal surprise at how quickly producers adjusted, with some officials privately admitting the move was completely unprepared for, given the integrated North American supply chains. The price adjustments are not isolated. They reflect a broader strategic pivot. Producers are prioritizing price discipline to maintain profitability amid global volatility. Global benchmarks anchored by 2026 contracts like the early settlement with China at around 348 per metric ton provide a floor, but the U.S. market now risks a political premium that decouples it from international norms. This could push Midwest spot prices 20–30% higher in the near term, exacerbating input cost pressures for corn, soybean, and wheat growers already grappling with low commodity prices and declining net farm income forecasts. Beyond pricing, the response includes subtle but significant redirection of volumes. While U.S. buyers rushed to stockpile in late 2025, contributing to record January export figures from Canada as anticipation built, producers are increasingly channeling tonnage toward higher-margin overseas destinations. Brazil remains the top international buyer, accounting for a substantial share of exports, followed by strong demand in India and China, where agricultural expansion and soil nutrient needs drive consistent purchases. These markets, less exposed to North American political friction, offer stable, lucrative outlets. Canpotex, the overseas marketing arm for major producers, has long emphasized reliability to these regions, shipping millions of tons annually to support crops like soybeans, corn, and sugarcane. This shift underscores Saskatchewan's growing flexibility. With infrastructure investments, including new export terminals and delayed expansions like BHP's Jansen project, now slated for late 2026 startup, Canadian capacity is poised for growth without over-reliance on the U.S. market. In 2024-2025 data, overseas sales already captured significant portions, and analysts project further acceleration if U.S. tariffs materialize fully. Redirecting supply softens pressure on global prices while allowing Canadian miners to capture premiums elsewhere, turning a potential threat into an opportunity for diversification. The move has stunned Washington precisely because it flips the narrative. Trump's administration framed tariffs as leverage to encourage reshoring, yet the immediate outcome is higher costs for American farmers, potential supply squeezes ahead of spring planting, and no quick path to self-sufficiency. U.S. farm groups have repeatedly warned of the fallout, noting that fertilizer comprises 30–45% of operating costs for many crops, and any spike lands directly on balance sheets already strained by forecasts of $30 billion plus drops in net income for 2026. As the USMCA review approaches in 2026, this pricing counterpunch signals Canada's resolve to defend its strategic asset. Producers are signaling they will not subsidize U.S. policy through lower prices, forcing a reckoning on both sides of the border. The integrated agri-food system that has benefited generations now faces its most severe test, with potash at the epicenter of a high-stakes economic standoff. President Donald Trump's aggressive push for very severe tariffs on Canadian fertilizer imports, particularly potash, is unraveling in ways that directly contradict the administration's goal of bolstering American agriculture. Announced as a means to encourage domestic production and reduce reliance on foreign suppliers, the policy instead threatens to deliver a sharp blow to U.S. farmers already navigating low crop prices and declining profitability heading into the 2026 planting season. The U.S. remains heavily dependent on Canada for potash, importing around 85–90% of its needs from Saskatchewan mines, according to data from the U.S. Geological Survey and industry reports through late 2025. Domestic production hovers at just 400,000 to 500,000 tons annually, against demand exceeding 5 million tons, leaving virtually no immediate capacity to fill the gap. Alternative sources like Russia and Belarus are hampered by sanctions, geopolitical risks, and elevated shipping costs, while new U.S. projects in states like Utah or New Mexico remain years away from meaningful output. Analysts now project that full implementation of higher tariffs, potentially ranging from the previously adjusted 10% to much steeper levels, could drive up potash prices for American buyers by 20–30% or more in the near term. Fertilizer represents 30–45% of operating costs for major row crops like corn and soybeans, meaning even modest increases translate into substantial hits to farm budgets. With corn and soybean prices remaining depressed amid global surpluses and trade uncertainties, many growers face the prospect of reduced applications, lower yields, or squeezed margins that could exacerbate forecasted drops in net farm income exceeding $30 billion for 2026. The backfire is evident in the administration's own framing. Tariffs were sold as a path to reshoring production, yet experts emphasize that building viable domestic mines requires billions in investment and a decade or longer timeline. In the interim, the costs fall squarely on farmers who cannot easily substitute potash, an essential potassium source for soil health and crop productivity. U.S. farm organizations, including the Fertilizer Institute, have repeatedly cautioned that such measures jeopardize North American supply chains and ultimately raise input expenses without delivering promised self-sufficiency. This dynamic compounds broader pressures on the sector. Corn and soybean growers, key to the Midwest economy, are already contending with elevated overall input costs, projected to rise 4–6% in 2026 due to a combination of global factors and policy volatility. The tariff strategy intended to protect and expand U.S. agriculture risks undermining it by inflating the very expenses the administration has sought to mitigate through aid packages and other relief efforts. Major Canadian potash producers Nutrien and Mosaic are adopting a firm stance on pricing as U.S. tariff threats loom larger in early 2026, refusing to absorb potential duties and instead maintaining disciplined export pricing to protect profitability. This approach directly challenges the notion that Canadian suppliers would lower prices to offset levies, instead shifting the economic pressure onto American buyers reliant on cross-border shipments. Nutrien, the world's largest potash producer with extensive Saskatchewan operations, and Mosaic, another key player, have signaled through industry channels and market behavior that they will not subsidize U.S. policy decisions. With global benchmarks supported by strong demand in markets like Brazil, India, and China, where early 2026 contracts have settled at competitive levels, producers are prioritizing margin protection over volume concessions to the U.S. This price discipline follows patterns observed in prior tariff episodes, where costs were largely passed forward rather than eaten by exporters. For Midwest farmers preparing for spring planting of corn, soybeans, and other potassium-dependent crops, the implications are immediate and severe. Spot prices in key U.S. hubs like New Orleans barges have shown upward pressure in response to uncertainty, with analysts anticipating further escalation if tariffs escalate. Without quick alternatives, growers face stockpiling rushes, potential shortages, or simply higher bills that erode already thin operating margins. The stance underscores the structural imbalance. Canada controls the world's largest high-quality reserves and efficient infrastructure, while U.S. dependence remains acute. Producers like Nutrien and Mosaic, controlling the bulk of output from active mines, are leveraging this position to redirect focus toward less politically volatile global customers when necessary. As spring approaches, the combination of elevated pricing and limited flexibility is setting the stage for heightened anxiety across Corn Belt operations, where fertilizer decisions directly influence yield potential and financial outcomes for the year. As trade frictions intensify in early 2026, Canada is wielding its unparalleled control over global potash supplies as a powerful defensive tool against President Donald Trump's tariff threats on fertilizer imports. Saskatchewan, which holds the world's largest known potash reserves estimated at 1.1 billion tons of potassium oxide equivalent, roughly a third or more of the global total according to Natural Resources Canada and USGS data, positions the country as the dominant force in this essential agricultural nutrient. With 11 active mines producing around 15 to 22 million tons annually in recent years and projections for further growth, including BHP's Jansen project ramping up later in 2026, Canadian producers like Nutrien, Mosaic, and others command supply chains that the United States cannot quickly replicate. The U.S. imports 85–90% of its potash needs, with Canada supplying the overwhelming majority, while domestic American output remains minimal at under 500,000 tons per year. This asymmetry has turned Trump's push for very severe tariffs, intended to spur reshoring, into a high-risk gamble, as experts describe Canada's response as a calculated demonstration of leverage. Trade analysts and industry observers have dubbed the approach a strategic masterclass, noting how Ottawa and Saskatchewan-based firms are using reserve dominance to maintain pricing power and redirect volumes towards stable international markets like Brazil, India, and China, rather than conceding to U.S. pressure. The move highlights the futility of rapid domestic alternatives, with new U.S. mines requiring years of development and billions in capital amid geological and economic challenges. In a striking contradiction, the U.S. Department of the Interior's final 2025 list of critical minerals, released in November 2025 and adding potash among 10 new entries for a total of 60, officially designates the fertilizer component as vital to national security and economic stability. The inclusion, driven by updated USGS methodology assessing supply disruption risks, public comments, and interagency input, recognizes potash's role in supporting U.S. agriculture, food production, and broader supply chain resilience. Yet President Trump's repeated threats of steep tariffs on Canadian imports directly target this same critical mineral, creating an ironic policy clash. The list, which qualifies designated minerals for potential federal incentives, permitting acceleration and other supports to bolster domestic capabilities, underscores America's heavy reliance on foreign sources, particularly Canada, which controls the most secure, high-grade, and politically stable reserves. U.S. farm organizations and Midwest growers are intensifying lobbying efforts for emergency exemptions or carve-outs, warning that tariffs would inflate input costs for potassium-dependent crops like corn and soybeans at a time when net farm income faces sharp declines heading into 2026. With midterms approaching, pressure mounts on the administration to reconcile the critical designation with protectionist measures, as any escalation risks self-inflicted damage to the very sectors the list aims to protect. The situation exposes the tension between strategic mineral security goals and immediate trade policy actions, leaving American agriculture caught in the crossfire of escalating bilateral disputes. Canadian potash exports to the United States surged to record levels in January 2026 as farmers and distributors stockpiled ahead of feared tariff hikes, with rail and barge data showing volumes exceeding previous peaks by double digits. The rush reflected deep anxiety over President Trump's threats of very severe duties on fertilizer imports, prompting a defensive buildup that temporarily masked underlying tensions. Now, with stockpiles filled and tariffs still looming, major producers are pivoting aggressively toward higher-margin international markets. Brazil, India, and China, where demand remains robust and contracts settle at premium levels, are absorbing redirected tonnage, allowing Canadian firms to capture better pricing away from politically volatile U.S. buyers. President Trump's multi-billion-dollar farm aid announcements, totaling over $12 billion in promised relief since late 2025, are being quickly overshadowed by the projected fallout from his own tariff policies on Canadian potash. Industry and USDA-aligned forecasts now warn of fertilizer cost increases that could add hundreds of dollars per acre for Midwest corn and soybean growers, dwarfing aid levels and driving net farm income down by more than $30 billion in 2026. With potash comprising up to 45% of key crop input expenses and no viable domestic substitute on the horizon, the mismatch between one-time bailouts and sustained cost inflation is fueling fierce criticism from farm state lawmakers and producer groups who argue the administration's protectionist strategy is inflicting far greater damage than any promised support can offset. With the mandated USMCA review set to begin in 2026, Canada is hardening its position on potash as a strategic asset, refusing concessions on export pricing amid ongoing U.S. tariff threats. Insiders from Ottawa and Saskatchewan describe the mineral, over which Canada holds unrivaled reserve and production dominance, as non-negotiable leverage in upcoming renegotiations. Producers like Nutrien and Mosaic continue to enforce disciplined pricing, redirecting volumes to global markets rather than absorbing duties, signaling that any attempt to force lower U.S. prices could trigger permanent supply shifts. Trade experts warn the talks risk becoming a defining battle over North American agri-food integration, potentially reshaping decades-old supply chains if protectionism prevails. The ripple effects of elevated Canadian potash prices are now reaching American dinner tables, as fertilizer cost spikes threaten to drive up food prices across the board in 2026. With potash essential for corn, soybeans, and other staple crops, industry projections show input cost increases could add 5 to 10% to overall production expenses, costs that farmers say will inevitably pass through to processors, retailers, and ultimately consumers. Meanwhile, the White House's vision of reshoring potash production faces harsh realities. Viable new U.S. mines require 8 to 15 years of development, billions in private and public investment, and overcoming geological and regulatory hurdles, leaving no quick fix for the current supply crunch and price pressure. From the shockwaves in Washington to the fields of the Midwest, this potash battle exposes the raw nerves of trade wars. Canadian producers hiking prices and redirecting supplies, U.S. farmers hit with surging costs and no quick alternatives, billions in aid overshadowed by policy backfires, and a critical mineral list clashing with protectionism. It's a masterclass in leverage, with Saskatchewan's reserves flipping the script, record exports turning defensive, and USMCA talks looming as a flashpoint that could redefine agri-chains. As consumers brace for higher grocery bills and reshoring dreams face decade-long delays, one thing's clear: this isn't just about fertilizer, it's about who holds the power in North America's food future. For more hard-hitting analysis, tune into the Kaitlan Collins report. And that's the stark reality check. American consumers on the hook, higher potash, soaring grocery bills, White House push to reshore production faces decade-long timeline and billions in costs.